three stocks reported this morning: Best Buy, Baidu, Big Lots. I have the results. They're all up. Last time I checked, before hours. Now the market's open. Let's see what happens. So first off, let's check the results of Best Buy. So Best Buy reported earnings per share of $1.57 versus $1.27 expected. That's a big beat. Revenue of $10.33 billion versus the $10.27 billion, and same-store sales were down 12.1% versus the 12.9% that was expected. So what does that mean? Well, when it comes to retail, the big factors are same-store sales. You'll see me talk about it every single time we talk about retail. My goal is to make sure that same-store sales are growing. But you saw in this situation, same-store sales were down compared to last year. Well, I think a big reason was last year we came off COVID. And COVID had once COVID went away, or once people were allowed to go back to the stores, they surged back into stores. You saw the same thing happen when you look at online sales as a percentage of total retail sales last year versus now. It's on the decline now because 2 years ago, it was such a surge due to COVID being the case. So let's use our 8-pillar analysis to look at all three of these stocks to see how they did. So we looked at Best Buy first. Now let's go and use our software to look and analyze Best Buy overall. So right now, Best Buy, oh my gosh, look at that. It's up 7% right now. That's a huge jump. Now, Best Buy is a company I like. At this price, we'll go look at that and see. I have puts on Best Buy at lower prices to see if I can get it for obviously much better. So let's go to the 8 pillars. Oh, wow. By the way, look at this. The stock's at 78. Its 52-week high is 142. So it's down significantly from its 52-week high. And its 52-week low was 65. So it's about 20% above its 52-week low. Some big things to look at here. Big dividend, 4%, pays out $700 million. And the 5-year average free cash flow is about $2 billion. So if you keep that one going, yeah, they can easily afford this dividend. But in terms of last year, the last 12 months free cash flow, it's a big chunk of the last 12 months free cash flow. So it's a little concerning for me. But of course, you want to sit there and look at the future of the cash flow. Is it going to stabilize back to 5-year averages, or is it going to stay in that 1 year previous trailing 12 months? Let's see what else we got here. Well, let's just go right to the 8 pillars. So if you're new to this channel, I'm Paul. I'm a value investor. My goal is to look at the quantitative aspects of a business. I want to look at the numbers and determine from there if I'm interested in the company and need to do more research. What's more research? It could be figuring out same-store sales. How are they growing? Are they taking away locations? What's the company doing with their money? There are so many questions to answer. But my 8 pillars will guide me along the way. So first question I have is, how is revenue up $8 billion? How is profit up 1.2, but yet cash flow is down $400 million? And we saw that in the 12 months. The 12 months showed that, hey, our free cash flow is down by over 50%, even though revenue and net income are up. Look at these 5-year PE and 5-year price of free cash flow. Basically single digits. That's incredible. Now remember, retail has a bad rap right now. Why? Because everyone thinks that retail is going away. I do not think that all retail is going away. That's literally not possible. Look at it this way. Do we still have trains? Of course we do. But when the car was invented, it drastically changed the way in which the train business operated. But we still do have trains. I know it might be seen as an extreme example, but it's something to keep in mind that as part of a value investor, my goal is to look at situations and say, are people over-exaggerating? People over-exaggerating the upside? Are they over-exaggerating on the downside? That could very well be the case. And by the way, if you like what I'm doing here, if you like this channel, please subscribe. And you want to see more about me personally, follow me on Instagram at Paul Gabriel, spell it right, and you'll be able to see more stuff about my personal life. But look right here. They're buying back a ton of shares. Now, buying back shares is great if the stock is cheap. Is the stock cheap? Well, I'd make the argument that here are some aspects of the company that I like that they're buying back shares. Cheap PE and cheap price of free cash flow. Okay, so when a company's buying back its own shares, it's basically investing in itself. It's doing a good job, if the stock is cheap, of being good capital allocators. The other thing is, when they buy back shares, they're saving on that dividend yield. So for example, if they buy back $10 billion in shares, hypothetically, I don't know what their plan is, but let's say they buy back $10 billion in shares. They're now saving $400 million on dividends. 4% of $10 billion is $400 million. They're saving that from their free cash flow, right? So they can use that money to do other things with, like buy more shares back. So that's another aspect of buying back shares that a lot of people ignore. So let's see here. I'm going to go to the cash flow statement to understand where cash flow really got affected here. Oh, okay. Look at this. Changes in working capital. This has been a very common theme lately. This is having to do with the net current assets versus current liabilities. So that was a big change here. This is a very big fluke year. They had a fluke year back here where it drastically changed free cash flow. So I'm not as worried about this as they manage their inventory better. That's probably my guess here. That's where it was. Yeah, probably. So this is a fluke year on the upside and probably 2 years in a row of really big free cash flow. So overall, I think maybe this 5-year average is a little high. Maybe it should be more like 1.5 billion, but we're right around there. So what's the market cap of the business? 17.8. So it's still around 11, 12 times free cash flow there. So let's go to our stock analyzer tool. Well, first, actually, let's go to our analyst estimates. And this is something new in our software that's going to be released very soon. It's going to show your analyst estimates. Now look at the EPS for the year. $10 right now is the estimations. It's going to fall big time and then start to grow back up. So even for the next 5 years, it's probably going to be pretty similar to where it's at right now, maybe a little bit higher. And look at the revenue. The revenue is actually expected to drop from 52.5 billion down to 47 and then grow from there again. So 5 years from now, it's expected to have lower revenue than it has today. This is going to be important for our stock analyzer tool. And the reason being is every investment is the present value of all future cash flow, right? So we don't know the future. We can only make assumptions about the future. I like looking at analyst estimates only to get a guide to see what I perceive to be the most optimistic people out there. Now, these analysts are all very active with the companies. They talk to the CEO, they talk to the boards, they try to get estimates of where they think things are going to be. My goal is to take those estimates and try to apply it to reality, okay? So the stock analyzer tool uses our assumptions about the future on revenue growth, profit margin, free cash flow margin, and then applies an ending PE and price of free cash flow to spit out some sort of return. I really encourage you on Best Buy and the next two companies we do, Baidu and Big Lots, to rewatch the stock analyzer portion. I want you to really listen to what I'm making assumptions about and why. Because a lot of people will sit there and say, you're being too conservative, right? And that's possible. But when I look at these analyst estimates, maybe my conservatism isn't that conservative, okay? It might take a while for them to get back to this year's revenue estimates. Because look, it took 5 years, not even back yet. So I want you to remember that as time goes on. So back to stock analyzer tool. Now, the last 10 years, they've done 2% a year in revenue growth. The last 5 years of 4.4. I'm going to be more conservative. I'm going to assume -1, -2, 1, and 4% revenue growth because we are going to have inflation here. And even though inflation will cause their expenses to go higher, it'll also get their revenue a lot higher as well. Profit margin. I'm going to go with 2.5, 3.25, and 4. Because if they're able to crush it, and I do think Best Buy is doing a much better job of doing online sales as well. I bought from Best Buy online. I actually prefer it if I'm buying an expensive electronic versus buying from Amazon because I want to be able to go to Best Buy and say, guys, I have a problem with this item. What can you do here? Amazon hasn't figured that out yet. Is it possible they do? Sure, but they haven't figured that out yet. Free cash flow. So I'm looking at 10 years at 3.2% and last year at 2. I'm probably going to ignore last year's number. And then the 5-year average of 4.3. So I'm going to go with 3, 3.5, 3.75, and 4.5. PE. Now, on a -2% revenue growth, a declining business, I want to go with a very low PE. I'm going to stick with 8. 11 and 14. And the reason being, if they're able to get their 1% revenue growth, okay, that's not a great company, but it's something, and I'll do 11 times, but I want to get my money back from buying back shares and dividends. And then 14 PE for 4% growth. Now notice, historical average of 15, I'm not applying that to retail because there's still a lot of headwinds for retail. So just remember that going forward. And price to free cash flow, I'm also going to do 8, 11, and 14 again. Now notice, the current price of free cash flow is high, but remember, we had a big drop in their free cash flow. I think that's a fluke. So I'm going to readjust that on there and not apply that big free cash flow multiple. And finally, for desired annual return, the market's going to do 9 or 10%. Our goal here is to provide some sort of margin of safety. So typically I'll do 12.5%, but for Best Buy here, I might go 12.5% on the low side because I do think negative 2% revenue growth is very low. And these revenue numbers, these profit margin numbers and pre-cash flow numbers are very low. So I might be more, remember, the lower the desired return, the higher the stock price. So I'm going to give it a little more buffer. But on the higher numbers, I might do 15% because I think these aren't as likely. So I'm going to put a little more margin in there. Now, the stock is currently at $76. And look, it's fallen down. It's only up 4% now. It's going to give me 6 numbers below. Low, middle, and high for earnings estimate and low, middle, and high for free cash flow, right? If it's all green, that doesn't mean go out and buy. It means go do more due diligence to figure out if these numbers are right. So how do you do due diligence? Go to websites and see what people are saying as a pro for the company, as a con for the company, the bull and bear argument. Go read their 10K. You can get their 10K from our website on the metrics page at the bottom annual report that takes you right to the SEC website. These are all things you can do. Or most importantly, join our community. It's less than a cup of coffee per day. There are thousands of people in there, and I guarantee people are talking about Best Buy. So you can sit there and have a conversation and use group research to understand the company. Listen, there are great conversations in there where people drastically disagree on a company, and I love the engagement there. So hit the Analyze button. Okay. Low side, somewhere in the 40s. High side, if you believe these high estimates, it actually looks pretty good right here. 100 to 110. I actually feel like if you truly believe this upside here, this is a lot of margin of safety because I already put a margin of safety in here at 15% and it's already selling at 25 to 30% lower than that price. And somewhere in the middle is around 60 to 70 range. So it's not far off from the middle range here. So that's something to do. What I would do here is add it to my watch list. Maybe I add it there at 65, 68 bucks. I hit notify me. And then on my phone, my email, and the software, if I'm a member, it'll notify me once the stock hits that price. Okay? So now you've got an idea of how to look at Stock Analyzer and our 8 pillars. So we're going to go a little bit quicker on these next 2 stocks. So Big Lots. Let's go to Big Lots next. I'm going to pull up Big Lots. Boom, 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 boom. Now, Big Lots reported and a loss of $2.28 per share versus $2.47 per share. So they did better because they were expecting a loss of $2.47. They were put at $2.28. They did $1.35 billion in revenue versus expected of $1.34. So they beat there. And same store sales were down 9.2% versus the 9.8% expected. So they beat on all levels there. Now, guys, remember, I don't necessarily care if they beat quarter to quarter. I'm looking for long term. That's what I do as a value investor. But I do acknowledge that quarter to quarter, it's going to make the stock move based on how they do quarter to quarter. But I don't put much value into what they do on a quarter to quarter basis. I'm more caring about the long term. So look at Big Lots. 52-week high of $52. Oh, isn't that ironic? And a low of 18, which they saw at the end of July. And they're currently at $22.76, up 6% today. Pays a huge dividend. Wow. Well, look at this. Free cash flow is pretty bad here, guys. My guess is working capital again, but this 6% dividend pays out only $40 million because their market cap is so low, $655 million bucks. All right, let's go to their 8 pillars. Oof, rough. Look at this, 2 times earnings, 197 times free cash flow. So right here I go, whoa. Why is there such a big difference between earnings and free cash flow? They're buying back a ton of shares. They have a lot of debt relative, but again, their free cash flow is very, very low on a 5-year average. So I'm just going to jump to free cash flow immediately. Oh, Boise. This is all over the board. And look at that. Change in working capital is a huge difference right here. So free cash flow was pretty bad. An average of $3 million. Why? Because, yeah. I mean, it's kind of a fluke. I would do a lot before. We're going to go do the stock analyzer tool, but this immediately tells me I can't get too excited about this company if it's all green or very close. I really got to understand the company and see where it's at. Big Lots, the thing I do like about Big Lots, look at their gross margin, 38%. That means for every dollar they sell, they add 38 cents to the bottom line. Now, if you go back to Best Buy, let's see how that compares to Best Buy. 22.2%. How does it compare to Walmart, another discounter? 24.6. Let's see Dollar Tree. 30.3. So I love that Big Lots has such a high gross margin, and I believe it's very consistent in the past. Like if you go run through their income statement, you're probably going to see gross margin is gross profit divided by revenue. I mean, look how, 40, it's basically 40% here, 40% here, 40% here, 40% here. It's basically 40% across the board. So they have a really high gross margin because their business model is to buy closeout items and sell it in their stores. All right, so let's go to the analyst estimates real quick. So, earnings per share. Okay, now look, big jumps here, right? But look at how many analysts are following it. Not many analysts have gone out that far. So keep that in mind when you're looking at these big jumps, all right? Keep that in mind. Revenue estimates. I mean, they are expected to drop in revenue, but then start climbing back up again. But again, not huge stuff. But if you're able to put up with the ups and downs, that might be okay. So let's go to our stock analyzer tool here. And again, I'm going to do a 10-year analysis. Let's see. I like the business model behind Big Lots. I don't know if you've been to Big Lots in a while. When I was a kid, Big Lots was kind of gross. It's actually pretty nice now. And I'm not saying that as a shock. I mean, they have a nice presentation. I love their gross margin. This is a stock I loved at the downturn at $11, and then it shot up to like 70, and now it's back to 20. So I'm going to look at this a little bit. So revenue growth assumptions. I'm going to go with -2, 1, and 4, just like Best Buy. Actually, I'm going to go 0 and 2 here. Profit margin. I'm going to go 3.5, 4, and 4.5. Free cash flow. Ooh. Man, this is a doozy. It's all over the board. 1.5. I'm going to go 1, 1.5, and 2. PE, 8, 11, 8, 10, and 12. Same with the price to free cash flow. And I'm going to go 15%, 12.5%, 15, and 15, just like on Best Buy. Now, this one, guys, I'm going to be a little more cautious on this one, but let's go look at the numbers here. Oh, boy, look at that, guys. Even on terrible free cash flow, it looks like it's pretty good. Now, you'll see a big difference here. Why is that? Between earnings, multiple of earnings, and discounted cash flow value. Well, look. PE and price to free and cash flow are very different. That's the major thing to figure out here in this company. That's the major thing. I'm looking at this going, wow, I'm interested, but I got to understand, why is their free cash flow and their earnings so different and over long periods of time? Look at this. Over 10 years, 3.8% versus 1.6%. That's what I need to understand. Immediately I look at it saying that's what I need to understand. Another thing I'm going to do on Big Lots is I'm going to sit there and see how their locations are growing or not growing. So I'm going to go to their 10K. And I'm going to go closed. So immediately right here, 2017 to 2021. I just did a search. And once you start using the 10K, and the great thing is if you join our community, a lot of people in there read the 10K or skim it for the information they need. I do the same thing. But when it comes to retail, look at this. 2017, they had 1,416 locations. They dipped, then they grew very slowly, which I actually like. And I like that they're being aggressive on their stores closed during the year. I want them, as retail changes and demographics change, start changing the way in which you operate your business. Close off the locations that aren't doing the best and focus on locations that could do better. That's a very important aspect here. Final company, Baidu. Now, Baidu is a little bit different. It's essentially the Google of China, right? So Baidu, now this is all in RMB, which is a Chinese yuan. But they had earnings per share of 1541 versus expected of 1066. So they crushed that. Revenue came in at 29.65 billion versus 29.45 Chinese yuan. And the average monthly user growth was up 8% to 628 million users. So with Baidu, it's the Chinese Google, but it doesn't have the profitability of Google. So let's go pull it up right here. I think the ticker symbol is BIDU. The high for the year is 182, low of 101. Let's see 5-year chart. Oh my lordy, look at that 5-year chart. February of 2021, it was 335. Holy cow. Let's go to the 8 pillars tab here. All right. So a pretty high free cash flow multiple. So this is a very fast growth. Listen, it's China. This is a very fast growing company. Let's go look at their revenue growth. Man, it's just all over the board here. Actually, it's not very fast growing revenue. It grew fast for a while and then stalled. Wonder why that is. You see this, guys? You have 3.4, 5.1, 7.5, 9.6, and then just stall out. Not much growth there. Go understand that. That's a very important aspect here. Go to the community, understand that. Let's look at profit. 1.5, 1.6, 1.9, 4.8, 1.6, 3.33, 300 million, 7, all over the board, guys. So that's why I like looking at the 5-year multiples on these things, because it's really important to understand that. Let's see what the analysts are saying. Are there any analyst expectations on this company? This is RMB still. Okay, the revenue. Yeah, I mean, it's expected to go really well. These are low double-digit growth numbers. These are high. These are mid-teens on the profit. So, okay, I gotcha. And remember, guys, these earnings estimates are based on Chinese yuan. All right, so let's go to our stock analyzer tool. Revenue growth. Let's go with 7, 10, and 13. Nope, sorry. What was the revenue growth here? Let me make sure that's the high side. Yeah, I'm not going to go that high for that one. I'm going to go 5, 8, 11. Profit margin, I'm going to focus on 12, 15, 18. Free cash flow, I'm just going to do that, focus on that. Now, PE, I'm going to go with 13, 15, 17, because it's still China. It's still the fastest growing middle class. It's got a huge market. People still, I'm sure the number of computers being used there, that's the big thing. 628 million active people per month. They have 1.6 billion people. There's still a lot of growth potential there for them as a company. Desired return, I'm going to go with 15 all across the board. Hit the analyze button. All right, so we have a low of 70, a high of 190, and a middle of 120. So for me, I'm definitely going to add it to my list at 120 to notify me. Why is it down suddenly? That's interesting. So it was up pre-market. Now it's down 7.6%. That's very, very interesting. So guys, this is my analysis of 3 companies that just reported this morning. If you liked what you viewed, please. We did a great video on Google, which is obviously the Baidu of the US. So go check it out next, and please subscribe to our channel. Thank you very much for your time.